Hello, my name is Melissa Golding, and I'm the press officer for the Group of 30. I'd like to welcome all of you to today's live webinar launch of the G30's new research report, U.S. Treasury Markets, Steps Toward Increased Resilience. We will begin the webinar with opening remarks from the chair of the Group of 30 Working Group on Treasury Market Liquidity, Mr. Timothy Geithner. Mr. Geithner will be followed by project advisors Darrell Duffie and Jeremy Stein and project director Patrick Parkinson. Please note that everyone will be speaking today on behalf of the Group of 30's Working Group on Treasury Market Liquidity. They are here to discuss the report and to answer questions about the report from the webinar audience. They are participating in this webinar in their personal capacities, and their participation does not imply the support of their respective public and private institutions. We will begin a roundtable Q&A discussion immediately following the formal remarks. I'm now going to turn over to Timothy Geithner, Chair of the U.S. Treasury Markets report.
Thank you, Melissa, and thanks to all of you for joining us. We're going to outline a comprehensive set of recommendations for how to make the U.S. Treasury market more resilient. These recommendations are the result of a 6-month process led by an exceptionally talented team of experts, Pat Parkinson as project director, along with Jeremy Stein and Darrell Duffie. Our work involved a working group of the G30 that includes 5 former central bank governors, 3 former senior officials of the Federal Reserve, and 2 former U.S. secretaries of the Treasury. We were able to benefit from extensive work on the functioning of the Treasury market and the events of last spring, including by the BIS, the New York Fed's Treasury Market Practice Group, research by Federal Reserve officials, and 2 important recent papers by Pat Parkinson and Ellie Lang, and by Darrell Duffie. We conducted interviews with more than 30 participants in the Treasury market, drawn from all parts of that market. We also commissioned an extensive survey of foreign central banks about the markets for government securities in their countries and the events in the early stage of the pandemic. We are grateful for that support and cooperation. Our objective has been to define a set of realistic and achievable recommendations to improve the functioning of the Treasury market. This market, as you know, plays a vital and unique role in the global financial system. This is a market that has outgrown its infrastructure and its regulatory framework. Oversight is fragmented and diffused. The capacity of existing market makers has not grown with the size of the Treasury market itself. The Treasury market needs a world-class regulatory framework with high standards for transparency, a more diverse set of participants, and a stronger financial foundation. Investors who hold Treasury securities should be able to finance them, borrow against them, and turn them into cash with ease in both normal conditions and in conditions of crisis. We have a series of suggestions for reform that would best contribute to these objectives. They have substantial merit on their own individually, but they are more powerful together. We believe these recommendations would make a significant contribution to improving the stability of the US and the global financial system. They will not by themselves remedy a range of other concerns with the structure of today's financial systems. They will not save the US from the risks of a prolonged period of excess fiscal borrowing if US policymakers choose that path, nor will they mitigate the risks that come from a prolonged period of exceptionally low interest rates. And they will not eliminate the need for intervention by the Fed to support parts of the financial system in a major crisis in the future. But they will make the foundation of the system more stable and better able to withstand the pressures that might come in the future. And even modest improvements toward these objectives can be extremely valuable given the importance of the Treasury market. Financial crises play a valuable role in exposing problems in the structure of financial systems that may not be evident in periods of relative calm. And yet it's often the case following periods of financial stress that the impetus to reform fades quickly. In the Treasury market in particular, the pressure for reform can be undermined by the belief that the Fed can always step in and fix things. This is not a particularly wise approach it's better to act when the memory of the last crisis is still fresh. We're going to begin with a short overview from Darrell Duffie about the events in the Treasury markets of March and April of 2020. And then Pat Parkinson is going to provide an overview of the recommendations. Jeremy Stein and Darrell Duffie will then provide more depth on the rationale for three particular sets of recommendations, those involving the Fed's role in the Treasury market, the capital regime, the regulatory framework that applies to the major participants in the Treasury market, and central clearing. And after these summary remarks, we'll take some questions. Thank you. So Darrell, over to you.
Thanks very much, Tim. On March 11th of last year, the World Health Organization announced its assessment that COVID-19 can be characterized as a pandemic. At about the same time, the Treasury market became largely dysfunctional. Demands to liquidate treasuries overwhelmed the intermediation capacity of dealers. The investors who sold large amounts of treasuries included relative value hedge funds, mutual funds, and foreign central banks. Treasury prices became exceptionally volatile. For example, the 30-year bond lost 10% of its market value between March 16th and March 18th. Bid-offer spreads quoted by dealers for off-the-run treasuries increased by a multiple of more than 10. Quoted market depth for on-the-run 10-year notes dropped from normal levels of about $300 million to about $25 million. The yields of similar maturity treasuries were no longer close to each other, and the yield curve was no longer a reliable gauge of market value. That's a problem not only for the Treasury market, but for many global financial markets that are priced relative to the Treasury yield curve. Treasury settlement failures soared. Over the worst 3 weeks, beginning March 16th, about $1.5 trillion of securities that were sold were not actually delivered on time. That elevated counterparty risk and further clogged up dealer balance sheets. Financing for treasuries suddenly became scarce. On March 16th and 17th, Treasury repo rates spiked far above the rate offered by the Fed on reserves. In short, US Treasuries did not serve their traditional safe haven role. Instead, dysfunction in the Treasury market actually worsened the pandemic crisis. So how did the Fed respond? Quickly and dramatically, the Fed offered unlimited liquidity to primary dealers in the Treasury repo market, and within a few days, this calmed the market for financing treasuries. But it wasn't until late May that conditions in the market for trading Treasury securities had returned to nearly normal. In the biggest central bank action ever conducted, the Fed purchased nearly $1 trillion of treasuries within the 3-week period beginning March 16th. This helped to free up space on dealer balance sheets, and the Fed continued to buy treasuries at a high rate. On April 1st, the Fed exempted treasuries and reserves from a key capital requirement on bank holding companies known as the supplemental leverage ratio, or SLR. The Fed and other key bank regulators followed suit on May 15th by extending this exemption to commercial bank subsidiaries. Jeremy will speak shortly about the role of the SLR. With these and other major actions by the Fed, the Treasury market eventually recovered its functionality. Over to you, Patrick.
The report makes 10 recommendations for enhancing the resiliency of the Treasury market under stress. The report argues that the root cause of the increasing frequency in recent years of episodes of Treasury market dysfunction is that the aggregate amount of capital allocated to market making has not kept pace with the very rapid growth of marketable Treasury debt outstanding. Accordingly, the central goal of the 10 recommendations is to increase, diversify, and stabilize market-making capacity in the Treasury markets. The 10 recommendations address 5 sets of key issues. First, Federal Reserve liquidity support for Treasury market functioning. Second, central clearing of trades of Treasury securities and Treasury repos. Third, prudential regulation of dealers. Fourth, market transparency. And fifth, market regulation. I will briefly summarize and explain the rationale for the 10 recommendations, but we'll gloss over some critical issues, details, and caveats. Then Jeremy and Darrell will give fuller justice to several of the recommendations. The willingness and capacity of firms to make markets is critically dependent on their confidence in their ability to fund inventories of Treasury securities that they acquire as a result of their market making. Ultimately, complete confidence can come only from direct access to liquidity from the Federal Reserve. Currently, only banks have such direct access on a routine basis, and under stress, the Fed has extended access only to a small group of primary dealers. In principle, banks and primary dealers can obtain liquidity from the Fed and on-lend it to others. In practice, under stress, those firms have been unable or unwilling to fully meet the demands for funding at rates low enough to allow firms without direct access to continue to provide liquidity to the Treasury markets. Consequently, the report concludes that the single most important measure that should be taken to enhance market-making capacity is to create a standing repo facility that would guarantee to a broad range of market participants the availability of repo financing for Treasury securities. Jeremy will say more about the rationale and the details of that recommendation. Central clearing of Treasuries and Treasury repos has the potential to increase, diversify, and stabilize market-making capacity. However, the potential benefits and the potential costs of central clearing of Treasuries differ for different market segments and different transactions types. Moreover, wider central clearing would further concentrate risk and responsibility for risk management in the central counterparty, the Fixed Income Clearing Corporation. As Darrell will discuss, our recommendations on central clearing take into account these distinctions and the concerns about concentration of risk in the CCP. Although the report's recommendations are intended to broaden and diversify market intermediation and reduce the current reliance on a small number of very large broker-dealer affiliates of global systemically important banks, in the near term, the liquidity of the Treasury markets is likely to remain reliant on those bank-affiliated dealers. As Jeremy will discuss, some elements of the post-financial crisis bank regulatory regime, especially as implemented in the United States, may be unnecessarily discouraging the allocation of capital to market making. Thus, we recommend that banking regulators review the treatment of market intermediation with a view to identify provisions that could be modified to avoid such disincentives without weakening the overall resilience of the banking system. Also, in light of the importance to the Treasury market of the resilience of broker-dealers, including interdealer brokers, that are not affiliated with banks, we recommend that the SEC review the robustness of prudential safeguards at such independent broker-dealers. With respect to market transparency, since 2017, Treasury transactions data have been collected and shared among U.S. regulators. However, the coverage of the data collection is not comprehensive, and only aggregate data have been made public. We recommend that coverage be made comprehensive and that with limited exceptions, the data collected should be made public in a manner similar to the way that data on corporate bond transactions are disclosed, which is near real time. We also recommend that the SEC's regulations, ATS and SCI, be applied to all significant trading platforms for Treasury securities, including both interdealer platforms, as the SEC has proposed, and multi-dealer, dealer-to-client platforms. Last, the report calls for more rigorous regulatory oversight of the Treasury market. The most important financial market in the world should be subject to comprehensive regulatory authority that is exercised effectively. As an important fourth step toward more vigorous oversight, the report calls for Treasury to lead an interagency study that identifies the myriad instances in which Treasury securities have been exempted from U.S. securities laws, evaluates the rationales for the exemptions, and where there is no clear and compelling rationale, recommends measures for applying those laws to the Treasury market. Thereafter, the Treasury should prepare an annual report on Treasury market functioning. With that overview of the recommendations completed, I'm going to turn it over to Jeremy Stein, who's going to talk about the standing repo facility recommendation.
Okay, well, thanks, Pat. As Pat said, our first recommendation is that the Fed create a standing repo facility that provides very broad access to repo financing for treasuries on terms that discourage use in normal times without overly stigmatizing use under stress, by which we mean conservative haircuts and lending rates above those that would prevail in the market in normal times. I'm going to try and address 3 points. One, why a standing facility as opposed to just rolling out something on an ad hoc as needed basis? Second, why broad access? And third, what about moral hazard considerations, particularly if we have a broad access facility? So on the first, why a standing facility? Our view is that an important part of the benefit comes from market participants knowing ahead of time that repo financing will be available in a stress situation. The hope is that this will stay the hand of those who might otherwise rush to raise cash by preemptively selling their treasury securities in an effort to get out of the market before prices move against them. Because now they have, with a repo facility, they'll have the confidence that if they sit tight, they'll be able to monetize their treasuries as needed by borrowing from the Fed. If instead we had an ad hoc facility that was only activated under stress, you might be well into the early stages of such a preemptive selling spiral before you could give market participants the assurance that they didn't need to sell because they were going to have access to widely available financing. Now, what about broad access? We know that in March 2020, much of the selling that put pressure on the market came from non-bank and non-dealer entities like mutual funds and hedge funds who had sudden large cash needs. Again, the hope is that if they know that they have certain access to repo financing, they won't be in as much of a rush to sell, again, thereby cutting off some of the spiral before it starts. Now, if you have a narrow access facility where the Fed, let's say, only lends to regulated banks or to banks and dealer firms, you then need to count on those firms being able to turn around and on-lend to the mutual funds and the hedge funds in this example. And as Pat noted, especially in a stress situation, you can't always count on this on-lending happening because the banks and the dealers' willingness to do the on-lending, to turn around and take the Fed liquidity and pass it on to the mutual funds and hedge funds is held back by some combination of regulatory constraints on their balance sheets getting larger, as well as their own internal tolerance for taking on added counterparty risk at a very stressful moment. So if you have a narrower access facility, the worry would be that the Fed's liquidity provision effectively gets stuck in the bank dealer sector and never makes its way to those who need it most. Hence our recommendation that access to the facility be made broad as is operationally practical. Now, this raises the question of whether a broad access facility creates a form of moral hazard by, for example, encouraging certain market participants to lever their positions more aggressively. A couple of points are worth noting here. First, this broad access facility is intended only for US Treasury securities. And again, we envision the Fed having a conservative haircut schedule so that it would be very well protected against any possibility of loss. And second, and again, this is importantly unique to treasuries, to the extent that a broad access facility encourages some market participants to play a more active role in the treasury market, this would push up treasury prices or alternatively reduce their yields with a benefit that accrues then directly to taxpayers. And again, it's worth noting, this is very different than if, say, the Fed were creating an analogous facility for corporate bonds and thereby creating a similar benefit for the corporate issuers of those bonds. There the case for limiting access or for charging a fee for it would be clearer. But in the case that we're thinking about here with treasuries, the ultimate beneficiary, again, is the US taxpayer. And so the value created by the facility is properly internalized. With that, let me turn it to Darrell, who will discuss our recommendations pertaining to central clearing.
Thanks very much, Jeremy. So first, central clearing interposes a clearinghouse between buyers and sellers. So for example, suppose Jeremy buys some securities from Pat today. If they centrally clear their trades, then Jeremy's and Pat's settlement obligations tomorrow would be to the clearinghouse and not to each other. The failures of some treasury dealers in the 1980s prompted the introduction of a clearinghouse for US treasuries, which later became the Fixed Income Clearing Corporation. In addition to lowering counterparty default risk in the treasury market, central clearing increases market transparency and significantly lowers the settlement failures that I spoke about a few minutes ago, as shown in recent New York Fed research by Michael Fleming and Frank Keene. A dealer's commitments to settle its purchases and sales offset each other if they are centrally cleared at the clearinghouse, further reducing counterparty risk and conserving dealer balance sheet space, which is precious in stressed markets that we saw last March. The Fleming and Keene study shows that on peak days last March, broad central clearing would have lowered dealer settlement commitments by over $600 billion a day on peak days. The G30 report recommends broader central clearing for the interdealer market and for treasury repos, as Pat said. These two use cases are the lowest hanging fruit. We recommended starting here. The report also recommends a study of how to bring central clearing into the customer to dealer market for trading treasuries. And here, a study does not mean kicking the can down the road. Broad central clearing should not be mandated until we better understand how the central clearing of customer trades would be sponsored by broker-dealers, and until we have a better idea of the costs and benefits of broad central clearing for the customer to dealer market. Broad central clearing, if designed well, would also encourage all-to-all trade, further reducing the reliance on the market on the limited balance sheet space of the major dealers. With more central clearing, however, the clearinghouse becomes even more systemically important. The G30 report recommends a thorough and independent review of the design and operation of the Fixed Income Clearing Corporation. And this recommendation is not only about the safety and soundness of the clearinghouse, it's also about access, making sure that incentives and costs are aligned well for wider participation. I'm turning it back to you, Jeremy, to discuss capital regulation.
Okay, thank you, Darrell. So as Darrell just said, another of our recommendations concerns bank capital regulation. I should emphasize at the outset, and this is important, that all of us involved in this report are strong supporters of the post-financial crisis reforms that significantly boosted the amount of equity capital in the banking system. But with that said, one aspect of this post-crisis capital regime has turned out to be problematic. This is the so-called leverage ratio, which imposes a uniform capital charge on anything that sits on a bank balance sheet, irrespective of its level of risk. The leverage ratio was initially intended to serve as a backstop to the conventional risk-based capital regime, rather than as a primarily binding constraint, in which case its risk insensitivity would not have had a meaningful impact on day-to-day behavior. But as it turns out, And this is in part because of the dramatic expansion of the Fed's balance sheet, which has meant that the banking system has had to absorb much more in the way of reserves than expected. It turns out that the leverage ratio has become, for many of the largest bank holding companies and therefore for their dealer affiliates, either the binding or near binding capital standard for these institutions. For the issues at hand, this has meant a large capital charge disincentive to two relatively safe activities. The first of these being market making in treasuries, which naturally requires intermediaries to hold inventories of treasury securities on their balance sheets, as well as offering repo financing against treasuries, which has a similar effect, again, on their balance sheets. If the risk-based regime was the more relevant constraint, these disincentives would not be at play in the same way. And Pat mentioned this, while it would be healthy for market making in treasuries to ultimately be less concentrated in the largest banks, the simple reality is that these banks are going to be important providers of market making services in any market structure we can envision in the near to mid future. And so it's important for us to remove artificial constraints to their participating in this activity. This suggests that bank regulators should take steps to make the risk insensitive leverage ratio less binding and more of a backstop, so that the risk-based capital regime again becomes the primary standard shaping day-to-day behavior and incentives. In the report, we don't take a stand on exactly how this might be implemented, and one can imagine alternative routes to the same outcome. For example, as was done on a temporary basis, and Darrell mentioned this, reserves could be excluded from the denominator of the calculation. That would tend to make the ratio less binding. Alternatively, you could leave reserves in, but hold the banks to a lower target ratio. Now, there are some subtle pros and cons to either, but both would have the desired effect of removing what is currently a significant deterrent to private sector market making and repo financing of treasuries. A final point, whatever changes are made to the leverage ratio, we think it's important that the necessary compensating adjustments be made so that the overall dollars of capital in the banking system don't decline. Again, just want to emphasize, nothing we're saying here should be taken as suggesting a weakening of overall capital requirements. We would like to see these capital requirements remain highly robust, but at the same time, remove the problematic distortions associated with the current primacy of the leverage ratio. So with that, let me turn it back to Tim for some summary remarks.
Thanks to all of you for those presentations. Just a few final points of emphasis. I think it's important to recognize that no financial system could have withstood the shock of the pandemic without exceptional actions by central banks around the world, including by the Fed in the US. But weakness in the Treasury market intensified the crisis in ways that was quite damaging. Making the Treasury market more resilient would reduce the damage to the financial system caused by future shocks, whatever the source, and reduce the need for exceptional action by the Fed in crisis. Just a second observation. We say in the report that a standing repo facility by the Fed is the single most important recommendation. Just 2 points about this. Although this would be powerful on its own, and the Fed can do it on its own, and has thought a lot about how to do it, we believe it would be more effective if combined with the other recommendations outlined here. Just a second point on the standing repo facility to emphasize something that Jeremy said. For a standing repo facility to be really effective, it should be open to a broad range of financial institutions, broader than just the primary dealers. There's some complicated factors in deciding how broad to go, and we give one possible solution to determining eligibility for access. The post-crisis capital regulations that apply to banks have made the banking system more stable. That's a very valuable thing. We very much want to preserve that. But parts of that complicated set of post-crisis rules operate to make the financial system less stable because they limit the capacity of key participants to devote capital to market making in the Treasury market. This can be fixed. It's very important to say this can be fixed without eroding the overall level of capital in the banking system or creating a slippery slope towards a weaker set of constraints on risk taking. Just a final set of thanks. I want to thank again Pat Parkinson, Jeremy Stein, and Darrell Duffie, and the G30 working group as a whole. Pleasure to work with all of them. And I want to thank Stuart McIntosh and his team at the G30 for all their work and support of this project. We'd be happy to answer any questions.
We have one question to lead off with. Many believe that the introduction of the SRF, the Basel III leverage ratio, was one of the most important post-global financial crisis banking reforms. Nikola Terashev, head of financial systems and regulation at the Bank for International Settlements, asks, what are the pros and cons of loosening regulatory constraints on bank balance sheets at this time? How should global standards treat the sovereign debt of countries other than the United States?
Jeremy, would you like to do that?
Sure. Again, I hope we've made clear that there are two sort of logically distinct issues here. One is how robust do you want the overall capital regime to be? Basically said, how many dollars of capital do you want there to be in the banking system? And the second issue is how do you implement that? What is the sort of set of rules that you use to get there? It's analogous to saying, you might want to have more tax revenue on the one hand, but you might want to get there by broadening the base and lowering marginal tax rates to avoid distortions. That's what we want here. I think we simultaneously want to have a very robust capital regime, but to avoid distortions. And the leverage ratio, which was important, but again, was initially conceived as a backstop, has turned out to be, for many of the most important players, effectively setting the marginal tax rate on activities, and treats holding a treasury security the same as a leveraged loan. And that's just distortionary. They're just not the same risk. And so we're basically advocating trying to ease that distortion, again, without, and just, I can't emphasize this enough, without weakening the overall capital in the banking system.
Thank you very much. Our next question is from Anil Kashayap at the University of Chicago. He asks, what will the combination of clearing recommendations along with the broad access to the standing repo facility mean for the role of principal trading firms in the Treasury market? Do you expect that they will become more or less important?
That's a great question, Anil. And we do address that in our report. I'd also like to mention that the principal trading firms of which you spoke issued a report just in the last 2 weeks that discusses in detail the impact of central clearing for the principal trading firms. And they are in favor of central clearing, but they also raise concerns about their access to the Fixed Income Clearing Corporation. And I would, rather than taking up time today, I would turn you to the report because it explains some of the frictions associated with those principal trading firms becoming clearing members or getting access to clearing through broker-dealers. And I think that we addressed that in our recommendation to do a careful review of the operations and other aspects of the Fixed Income Clearing Corporation. That's, again, as I mentioned, not only about safety and soundness, it's also about fair access. I'd also mention that our suggestion or recommendation to do central clearing in the interdealer market, including principal trading firms, is not original. It's been raised a number of times, going back to the 2015 joint agency study. Congress requested testimony on this issue, and the Treasury Market Practices Group also addressed this issue, raising concerns about not having the principal trading firms involved in central clearing. So we're in line with concerns that have been raised earlier in this area. I'll leave it right there. Thanks.
Pat, Pat, anything you want to add to that?
No, I think Darrell did an excellent job answering it, and I would endorse his call that we would have benefited, I think, from having access to the study. It was recently released by the Futures Industry Association's PTF group. And as Darrell said, somewhat to my surprise, they are in favor of central clearing and simply think that some adjustments to the existing sponsored repo or sponsored clearing model of FIC are needed for that to be an effective mechanism for achieving that end.
Thank you.
Thank you. Our next question is from Ted Truman, Senior Fellow at the Mossavar Rahmani Center for Business and Government. Were your concerns and recommendations motivated by preserving the international role of the US dollar? Put the other way, do you think your reforms recommendations will help to preserve the US dollar's international role?
Yes. But Darrell, you've written about this. Would you like to elaborate on that?
Well, of course, one of the reasons that the dollar is called a reserve currency is that foreign central banks purchase US treasuries with the view that they will be a safe haven. And last March, they might have been slightly disabused of the notion that they could rely on their treasuries. The US Treasury Department benefits when investors, not just foreign central banks, but all investors globally, rely on the treasuries as a safe haven. And so this report is definitely motivated in part by the important role of the US Treasury market in supporting the reserve currency status of the dollar, and in general, financial stability and market transparency benefits to the entire globe. Of course, all of those benefits spill back to US taxpayers because they lower the cost of financing US deficits. So yeah, absolutely, that's a key motivation.
Thank you. Our next question is from Paul Sheard at the Harvard Kennedy School. What to some is market stress, to others will be market signals. When it comes to market functioning, how do you think about ensuring the Treasury market functions as a transmitter of underlying forces and signals in the economy among market participants?
That's an interesting question, like all your others. Good question. I don't know, lots of ways to think about that question. Jeremy, what do you think?
So one angle on this, I think what's lurking a little bit behind this question is, geez, we don't like the idea of the government sort of getting in the way of a needed market adjustment. That's one way to sort of hear this question. And I think it relates a little bit to some of the moral hazard concerns that people have expressed. And what I want to say is that, the fact that we're sort of advocating this broad access standing repo facility, I think some people think, well, you're sort of interfering with the market. I think an important perspective is the idea is that if you allow people to finance, right? So we're only thinking of allowing people to finance their holdings of Treasury securities. They're still going to hold all the interest rate risk, right? Whereas the concern would be if they can't finance them, they're going to have to sell them. And in a stress situation, if they're forced to sell, you'll see what we saw this time is that the Fed not only steps in on an ad hoc basis with a financing facility, they do an enormous amount of buying. So I think to the extent that one is concerned, and I'm not sure the right way to frame it, but if you're concerned about that somehow interfering with market signals, I would say one virtue of the repo facility is it lowers the likelihood and the incidence of the Fed having to step in on an ad hoc basis and do a bunch of buying, because hopefully it forecloses some of the selling. So in that sense, I would view it as a little bit more market friendly and a little bit more causing people to internalize the duration risk that they're taking with their positions, because it's a little less likely that the Fed is going to be taking that risk off their hands with an ad hoc purchase program.
Thank you. Our next question is from Mark Zashin at Walmart Investments. He asks, how do shadow banks fit into your recommendations?
I guess you could say, but maybe Pat, you should do this, that by suggesting that a standing repo facility should be open to a broader range of participants, we're making the public policy case that there are benefits from making sure that what only the Fed can do in a crisis reaches more broadly into the market and is not constrained by aspects of the plumbing of the current system. We also make a suggestion in the report about that the SEC should take a look at the capital regime that applies to a range of other participants in the market. We think there's a lot of benefit from that. But Pat, do you want to elaborate on that?
Sure. Well, maybe first start out by saying, as you said at the outset, Tim, we are not solving all of the financial system's problems through implementation of these recommendations. Obviously, there are issues, concerns about the so-called shadow banking system or the non-bank financial system, particularly the parts of that system that engage in leverage and maturity transformation, and those need to be addressed. But I think we don't want a world in which shadow banks are engaging in fire sales because they cannot find financing for their treasury securities. That's whatever role the shadow banks are playing, their inability to finance those positions under stress is just making a bad situation worse.
Our next question is from Paul Hutchin at BNP Paribas. How does central clearing address or not address the issue of price discovery?
Great question. I'll take that one if it's okay. Well, first of all, central clearing makes for a more orderly market for all the reasons that we've described and are in the G30 report. And a more orderly market implies better price discovery. In March of last year, the degree to which a given yield was representative of what a smooth yield curve would imply was off by about a factor of 3. That is, the noise in the yield curve was dramatic. Central clearing would contribute to reducing the amount of dysfunction and make the yield curve smoother and therefore more representative of fair market value. It's also, of course, the case that if you have central clearing, as I mentioned in my remarks, it increases the likelihood that you will get exchange-like trading conditions, all-to-all trade. And once you have that, you have price transparency not only for the on-the-run securities that are traded electronically in the interdealer market, you could potentially have price discovery on limit order books for a much wider range of securities. And that would also improve price discovery. But you can't have all-to-all trade, or at least it's more difficult. Let me not say can't. It's more difficult to arrange all-to-all anonymous trading without central clearing. So altogether, I think it's a plus for price discovery and price transparency.
Yes, I'd add, that's all correct. I agree with that. Call your attention to the recommendation with respect to market transparency. Currently, I think in the Treasury market, there's good transparency for unruns, not so good transparency for off-the-run Treasury securities. Even in the absence of clearing, and we are calling for wider clearing, you could increase transparency a great deal by publicly disclosing the data on off-the-run pricing that's already being collected through the SEC's FINRA arm and shared among the regulators, but as yet not made publicly available, not in real time, not ever, in fact, in stark contrast, for example, to the policies with respect to public disclosure of corporate bonds.
Thank you. Our next question is from Michael Pedroni at the Managed Funds Association. These recommendations are thoughtful, and we and our members, global hedge funds, will examine them closely. I noted at the beginning that you referenced hedge fund RV as a big seller in March 2020. The Fed's research and our own shows that basis traders accounted for $35 billion in sales against a total system-wide volume of selling of $635. Can you clarify that the big sellers were foreign accounts who wanted to raise dollars?
I'll take a run at that one as well. So first of all, I want to make clear that the G30 report is not pointing fingers at investors and suggesting that they were wrong to sell treasuries in a general sense. In fact, if the G30 recommendations were adopted, investors would be more confident that they could buy treasuries in normal times and then sell them quickly in a stress period, as they did last March. And that safe haven service to investors globally is a good thing. It's good that many investors felt that they could trade treasuries last March, although as it turned out, in some cases they couldn't. So having said that, it is true that the largest sellers, according to Fed research, the largest sellers were foreign official sector accounts, which we suspect are simply foreign central banks that were managing their foreign exchange reserves by selling treasuries and raising cash. But Fed research also shows that relative value hedge funds, broader than the basis traders that you spoke of, that in a broader sense were significant sellers of treasuries. And I can, Michael, if you get in touch with me afterwards, I can send you the paragraphs in the board research that shows those numbers. And mutual funds were also, of course, large sellers. But there's nothing in our report that admonishes investors globally for selling treasuries.
Thank you. I have another question from Don Cohn at Brookings. On the SRF, can you elaborate on how to determine and implement broader access?
Pat, do you want to do that?
Sure. One possibility that we suggest, and it's by no means the only possibility, is by providing access to netting members of the Fixed Income Clearing Corporation. I think there are about 175 such members, including both banks and broker dealers. An advantage of that is that it is substantially wider access than the current access afforded to primary dealers and insured depository institutions, and focuses on institutions that have a commitment to providing liquidity in the Treasury market. It also benefits from the fact that all those participants subject to membership requirements from FIC that generally require them either to be a bank or a broker dealer subject to those regulatory regimes, and to an additional oversight from the Fixed Income Clearing Corporation itself. Again, that's not the only possible way, but it's one way that at least to some important degree addresses moral hazard concerns and allows for a substantial increase in availability. But again, over the longer term, we're for very broad access, and FIC really is more a practical, pragmatic way that the Fed can widen the access in the near term without considerable effort developing new pipes and plumbing.
Thank you. Our next question is from Bill Nelson at the Bank Policy Institute. He says, thank you all for the work and thought that went into this report. If it is distortionary that banks are being required to hold more capital because the Fed's balance sheet has ballooned, why is it desirable that the overall level of capital requirements be maintained at its current level? Why isn't the appropriate level the amount required if reserve balances were the size expected when the federal banking agencies calibrated the post-global financial crisis set of capital requirements?
Jeremy?
Again, I think what we're most keen to do is to express a qualitative view that one can, remove the distortions associated with the leverage ratio without weakening the amount of capital in the banking system. Now, there has been a longstanding debate, and Bill, you're on one side of this debate, and I suspect that some of us might be on the other side about exactly how robust. Again, this is more the analogy of how much revenue you want to raise, how robust you want capital to be. And I suspect we have probably a bit of a disagreement. But I think the most important point to make here is that these are separable questions, and that one can be in favor of essentially defanging the leverage ratio in terms of its daily bindingness without being someone who's basically favoring a rollback of bank capital. I'll just express personal comfort with the idea of having capital sort of somewhat on the higher end of the spectrum. But again, they're just two logically distinct questions.
Thank you. Our next question is from Pierre Darpy at the French Financial Markets Authority. Did you also observe issues on the shorter maturity treasury bills / notes markets? Would your recommendations also apply to these shorter term paper?
Good question. Darrell, do you want to start?
I'll start, and I might need some help, Tim. But let me say that, Tim, you mentioned in our press release, and the report describes the process by which we gathered information. And the information that we gathered suggested that the off-the-run treasuries were very, very significant contributors to the market dysfunction. And the statistics and the interviews that we conducted bear out that customers had difficulty liquidating off-the-run treasuries particularly. Now, among the off-the-runs, of course, are shorter maturity treasuries that were once on the run. Bills were not implicated to my knowledge, at least not unusually, but others could correct me. But off-the-run coupon issues that had been whatever, 2 years, 5 years, 10 years, 30 years, that are now shorter maturities would have been part of that. So in foreign central banks, for example, they buy on the runs, and then when they're ready to liquidate them during a stress period, by then they may be much shorter maturity. So I guess you could suspect that on average, the treasuries that were liquidated were shorter maturity than the on-the-run issues. But I don't have any specifics on, maybe Pat or others may have specifics on short maturity specifically.
No, I don't. I would say I don't think anywhere in our recommendations we've differentiated between short maturity and long maturity securities, and don't really see a reason to do so. As Darrell indicated, the liquidity problems, I think, were mainly in the off-the-run segment. As I think one of the interviews, someone pointed out to us that 95% of Treasury securities are off-the-run securities. And under stress, investors sell what they own, and what they own are off-the-run securities. So I think, if anything, my sense, one of the things I took away from this project is that we don't emphasize the off-the-runs enough. There's a tendency to focus on the runs because there's all this pricing data. It's a much more transparent market, but in many respects, the off-the-run is more important and needs to get greater attention.
If I could just add to that, I think this discussion about off-the-run highlights another sort of important virtue of the standing repo facility, which is there's always going to be essentially a peak load problem with off the run because they don't trade much in normal times. There's just not going to be that much market making capacity devoted. And no matter what market architecture, you're just never going to have that much market making capacity devoted towards them. But of course, in a crunch, there's a disproportionate selling of off the run relative to that relatively thinner market making capacity. So that's where, if they can instead be financed at the Fed rather than sold, I think you could eliminate, for sort of a smaller amount of total financing provided by the Fed, you could eliminate a relatively larger portion of the dysfunction in this market. Because again, you're never going to solve the off-the-run problem by trying to have a huge amount of market-making capacity devoted to it, because that capacity would just be idle, in most normal times.
Thank you very much. I think we have time for just one last question. This is from Costas Stefano, the head of financial stability analysis at the Financial Stability Board. The question is, to what extent would the G30 recommendations enhance the elasticity of dealer balance sheets in stress, such as during a March 2020 turmoil type event? How much would they change dealer incentives to trade? Willingness, not ability, given the prevailing uncertainty at the time.
That's a very good question. Darrell, you go ahead.
I'll start. That's a very broad one because many of the recommendations in the G30 report address specifically that issue. So for example, standing repo facility and FEMA, which is a standing repo facility for foreign central banks, reduces the need to sell. So even without considering elasticity, there's less volume for dealers to handle. The capital regulation of which Jeremy spoke would increase the incentive of dealers to absorb safe assets and increase the amount of available balance sheet space. So that would improve elasticity. The central clearing recommendations in the report all go toward not only safety and soundness, but also more efficient use of those dealer balance sheets, increasing their capacity. And as I mentioned, an additional feature of that is that it might incite all-to-all trade, which means that not every trade must go onto a dealer balance sheet. Many could go around them. Many of the recommendations, access to central clearing, for example, the FIC recommendations, all go in, many of them go in one way or another towards improving the ability of the large dealers to intermediate the market, make it more possible for those balance sheets to handle the flows under stress. So I think the report is very much focused on this issue of increasing the capacity of dealer balance sheets under stress.
Pat or Jeremy, anything you want to add to that?
Just that, again, our goal was to increase, broaden and diversify. So in addition to creating greater capacity on the balance sheets of the big bank dealers, our hope is that many of these measures would make it, would better enable the smaller dealers, whether they're banks or non-banks, to compete in this marketplace and to supplement and diversify the capacity for market making.
Good. Thank you all for an excellent set of questions and for participating in this this little seminar webinar.